Bloomberg's Phillip Yin sat down with World Bank President Bob Zoellick in Singapore.
In the broader issue of exchange rates, you're moving to what I call a Bretton Woods 3 system, where you have key roles for the dollar, the euro, the yen, the pound, and over time the renminbi, although it has to internationalize and then become an open capital account. What you want to try to do is develop a more cooperative basis for that, so that you don't either have the big gyrations or that doesn't be seen as unfair practices. I believe that over time you have to have countries be able to have flexible exchange rates. I think that you need to be able to try to avoid interventions except for extreme circumstances. For some of the emerging markets, you may have some hot capital flow issues to deal with. And so what needs to be done, partly with the heads, but also back with the finance and central bankers, is a sense of sort of norms or what are appropriate roles, and then have the IMF partly be the referee that observes those norms and, as necessary, blows the whistle.
China's been quite critical of the quantitative easing measures begun by the United States. Do you think that criticism is, I guess, does it raise any concerns, that type of criticism that you see, not just from China, but from also other developing countries as well?
You've actually seen different voices in China, and the central bank seems more accepting than some of the people at the foreign ministry, which may tell you a little bit of the internal politics of this. I think you need to divide the quantitative easing into two dimensions. One is the debate that's taking place in the United States about whether the added benefit one gets in slightly lower interest rates of the securities they purchase is worth some of the uncertainties and some of the long-term challenges of how they unwind that. What you focused on is the other question about how this affects the international economy. And here I think some of the concerns have been overstated, because even if you didn't have quantitative easing, as long as you have differential growth rates, you're going to see capital flow to these emerging markets. That's going to put pressure on their currencies. It's really a sign of their success as growth. And this isn't just emerging market. This happens in Australia, for example. And the normal response then is to deal with your monetary policies, raise interest rates. Part of the problem in the system is because the Chinese currency is pegged, it's hard for others to adjust if China doesn't adjust. And that's part of the discussion going on about exchange rates. There are circumstances where you may have hot money flows and may look at whether banking regulations, administrative controls, the Brazilians are trying to use taxes. In general, what that does is it tends to affect the maturity and where the money goes as opposed to the amount of money. But I think on the quantitative easing, I really don't see this as creating a flood of additional funds internationally. You're right, though, that it's made the debate tenser.